Hi, this is PR Sundar. Welcome to this special episode where I am going to talk about various avenues for investments in stock market. So in stock market, there is something called cash market and futures and options market. And people, they can either directly enter into stock market, they can buy and sell the shares, but most of the time we are not experts. So we want to hand over our money to experts. So that is where the mutual funds come into the picture. And a lot of people give some small money to mutual funds, and the mutual funds collect a lot of money from so many people, and they invest in stock market on behalf of the investors. So this is mutual fund. But however, the mutual funds are allowed to invest only in cash market. They are not allowed to trade in futures and options market. However, they can do hedging positions in futures and options, and that too 1:1 hedging, which means if a mutual fund has 1000 shares in cash market in Reliance, they can maintain short position in 1000 shares in futures, but they cannot short more than 1000 shares. So this is called 1:1 hedging. And of course, recently mutual funds have been allowed to sell call options only in Nifty 50 stocks. That is a recent development. So this is one part. And most of the time, mutual funds, they give just average return. They don't give fantastic returns. The second one called PMS. PMS stands for Portfolio Management Services. And you must have heard people like Poranju Valianth, Basant Maheshwari, and few other people. They collect money from you and they invest on behalf of you. What is the difference between mutual fund and PMS? Mutual fund, you can put any amount of money, whereas in PMS, the minimum you have to invest is 50 lakh rupees. So generally, the PMS is catering to HNI clients. So that is one major difference. Operationally, mutual funds, they are classified into many groups: large cap funds, mid cap funds, small cap funds, multi cap funds, Parma fund, sectoral funds, etc., etc. So they invest accordingly. But usually, the PMS managers, they tend to invest in micro cap companies. Not all of them, but most of them. And because they look to generate more return, then only they can get more commission. Whereas mutual funds, they charge only 1% or 1.5% per annum as their asset management fees. But usually these portfolio managers, they charge something like 2% every year, and on top of which, whatever is the profit you are making, they may charge about 20%. So the PMS charges are high. Because to justify these high fees, so they invest in more riskier assets. But once again, the PMS managers are not allowed to invest in futures and options market. They can also invest only in equity market. However, the recent development, they are allowed to do covered call strategy. That means if they are holding a particular company shares in their portfolio, they are allowed to sell call options against that portfolio. Again, it is 1:1. And the third one is a hedge fund. And many people think hedge as in a wrong way. Because many times I advise you must always hedge your positions. And many people think that hedging means forever there will be no loss, and that is not true. Even after hedging, you can have losses. But only thing is, your loss may be a limited loss. It may not be unlimited loss. First, let us understand what is the literal meaning of the word hedge. What do? You go to Google and type hedge and then click images and you see what you are getting. This is the literal meaning of the word hedge. Those days, if you remember, people don't construct the compound wall using the bricks. They just plant some trees close to each other. So it's a compound wall using the plants. Let us say you are constructing a house, and then what is the safety for your house? So to safeguard your house, you are actually constructing a compound wall. But constructing a compound wall, is it 100% safe for your house? No. You construct a compound wall, you close the gate, you are safe from cats and dogs. But you are not safe from Mr. P.R. Sundar. P.R. Sundar can go and buy a ladder for 1,000 rupees, can put the ladder against your compound wall, you can climb on the ladder, can jump into your house. Then one may say, sir, I will construct a compound wall 20 feet or 25 feet high. Then how can you come? You know what happened to Bin Laden? If you want 100% safety, you construct a compound wall all the four sides and then close on the top also. Then there will be no oxygen, there is no air, you will die. So, hedge means it is a safety, but it is not 100% safety. And that is number one thing. Second thing, many people, I am just giving an example. Let us say you are buying a Reliance share. Reliance share is trading around 2,000 rupees. The moment you buy a Reliance shares at 2,000 rupees, if you go and buy 1,900 put option. So tomorrow, if there is any black swan event, if Reliance Industries fall from 2,000 to 1,000 rupees, you still don't have to worry because your 1,900 put option will give you good profit. So your loss is maximum 100 rupees. Still you will lose, but only thing is you will not lose 1,000 rupees, but you will lose only 100 rupees. Many times I get queries. Sir, I bought this share for 1,000 rupees. It has already come down to 500 rupees. Sir, now please tell me how to hedge to come out without loss. Hedge is something you have to take as soon as you take the position, not after the share fall 50%. You are buying a car and you have to take insurance immediately. That is a hedge. And you buy a car, go and make lot of accident and then come and tell me, sir, how to hedge? Can I buy insurance? Yes, you can buy insurance, but that will protect only the future accidents. This accident you have to pay for it. So people have this wrong notion about hedge. Hedge means they think, it's 100% safe. 100% hedging will give you only 0% return. So you must understand this one. In US, there are hedge funds everywhere. Every Tom, Dick and Harry will be running a hedge fund. In India, we don't call this as hedge fund. So in India, it is called alternate investment fund category 3. And here, mutual funds, you can put any amount of money. In PMS, minimum is 50 lakhs. Whereas in hedge funds or alternate investment fund category 3, the minimum investment is 1 crore. But this alternate investment fund category 3, they are allowed to invest in futures and options markets. But still, there are not many hedge funds in India. Why? I will give you the answer in my next video. Hope you enjoyed the video. Thank you for watching.